Yes, a very good morning to you all. Welcome back to the class. In my last class, I have discussed about the treatment or the procedure for recording the capital expenditure is treated as revenue expenditure. What has to be done? How we record this transaction in the valuation of goodwill or adjusted profit. If capital expenditure is treated as revenue expenditure, it has to be added back to the net profit. Already I have discussed it in my last class. Please go to that video. So with this we'll start solving a problem. I want to solve a problem in this class. I have given the problem in the description of this video. Please go through that video. Please stop. Please pause the video and read the problem carefully. Come back to the class. Okay, I hope you have read. So they have given 4 years profit here. We have to calculate the goodwill here. We are supposed to calculate 3 steps here. We are going to solve this problem in 3 different steps. The first step is calculation of adjusted profit. The second step would be calculation of weighted average profit. The third step would be valuation of goodwill. This is how we are going to solve this problem. They have given 4 years profit here. We are supposed to calculate adjusted profit here in the first step. They have given 4 years profit. These are the profits I have noted down here. At the first adjustment, as you can see the problem, the first adjustment says that the major repair was made to the plant, rupees 30,000, is treated as revenue expenses. Usually, whenever we install any machinery, the erection charges of machinery, land, building, furniture, erection charges, installation charges, major repair made on any fixed assets is treated as capital expenditure. So obviously it is a capital expenditure, but they have wrongly charged to the revenue expenses. They have wrongly treated as revenue expenditure. So if capital expenditure is treated as revenue expenditure, what has to be done? It has to be added back to the net profit. I have discussed it in my last class. Please go through that. So capital expenditure on major repair, that is wrongly treated. Capital expenditure is treated as revenue expenditure. It has to be added back to the net profit. For which year? 30,000. In which year we have purchased the asset? It is 2018 and 19. So obviously it has to be charged to the previous year, 30,000. And they have given one more information in the first adjustment, that is depreciation. Here depreciation is at 10% on written down value method. When we have to give the depreciation, depreciation starts from 2017 and 18 because we have not used the asset for the first 2 years. Depreciation it starts from 2017 and 18. Here depreciation is at 10% on written down value method. So less depreciation. On capital expenditure. At a 10%. From which year? From 2017 and 18. 10% on 30,000. This is the depreciation for the first year. Second year, as we are calculating depreciation on written down value method, the value reduces here. So 30,000 minus 3,000. We have to provide depreciation on the reduced value. It is 27,000. So 27,000 into 10%. It is 2,700. As the depreciation is on written down value method, the value goes on decreases. Whatever the value goes on decreases, on that value we have to provide depreciation. So what will be the depreciation for the next year? 30,000 minus 3,000 minus 2,700. Whatever the balance left next year, we have to provide 10% on the remaining value. So now reduce the values. 1 lakh 1000 minus 0 is 1 lakh 1000, 1 lakh 24,000, 1 lakh 27,000, 1 lakh 47,300, 1 lakh 50 minus 2,700, it is 1 lakh 47,300, 1 lakh 30,000 minus 3,000, it is 1 lakh 27,000. Alright. The next adjustment, it says that overvaluation of closing stock by 12,000. In my last video, I already have discussed about this one, how it has to be treated in valuation of goodwill. If overvaluation of closing stock is given, it has to be deducted. It has to be deducted from the net profit. And to nullify the results and to show the effects as a zero, we are going to add the opening stock, overvaluation of opening stock by rupees 12,000 in the next year. By this vanilla, we are going to nullify the result. Whatever the overvalue, whatever the value that they have shown more, that has to be reduced back. To have an impact of that, we have to less the closing stock, less the overvaluation of closing stock. Then we have to add the overvaluation of opening stock by 12,000. Let us solve this one. Less overvaluation of opening stock. I'm sorry, less overvaluation of closing stock. I'm sorry. They have given the adjustment, that is overvaluation of closing stock. It has to be deducted. Overvaluation of closing stock. In which year there is an overvaluation of closing stock? In the year 2016-17. It is 12,000. Reduce this one. It will remain same, 1 lakh 1,000. It will be 1 lakh 12,000. It is 1 lakh 27,000. It is 1 lakh 47,300. To nullify this results, to show it as zero, we have to add back the overvaluation of opening stock for the next year. Whenever the adjustment is like this one, overvaluation of closing stock, first we have to deduct the amount from the net profit, then we have to add the overvaluation of opening stock to the net profit to show that effect, to nullify that results. Add overvaluation of opening stock. For the next year, opening stock obviously will be next year. One lakh 27,000 plus 12,000, 1 lakh 39,000, 1 lakh 47,300. And the last adjustment is to cover management cost. An annual charge 24,000 should be made for the purpose of goodwill valuation. So management cost, it is a regular expenses, it has to be deducted from the net profit. Less management expenses. It is considered for all the years. Management expenses. It is 24,000, which is considered for all the years. Yes, 1 lakh 1 minus 24, it is 77,000. It is 88,000. It is 1 lakh 15,000. It is 1 lakh 23,300. This is the adjusted profit, or it is the future profit. Adjusted profit. This is the first step to to calculate the adjusted profit. The second step would be calculation of weighted profits. I think it is over. Yes. The next step would be calculation of weighted profits. They have given weight for all the years, weights for all the years. Second step, calculation of weighted profits. Step number 2, calculation of weighted average profits. Weighted average profits. They have given weights for all the 4 years. The first year weight is 1, second year weight 2, 3, 4. So based on that one we have to calculate. The first column will be year. Second column adjusted profit. Already we have calculated this one. Adjusted profit. Adjusted profits, weights. This is product. There are 4 years. Adjusted profits, weights. It starts from 2015-16, 2016-17, 2017-18, 2018-19. Already we have calculated the adjusted profit in the last step. Note down the adjusted profits. First year adjusted profit is 77,000, 88,000, 1,15,000, 1,23,300. And the weights they have given in the problem. Weights are for the first year 1. It is there in the problem. Second year weight 2, third year weight 3, fourth year weight is 4. It is there in the problem. So how to calculate the product? It has to be multiplied. Adjusted profit has to be multiplied by the weights. 77,000 into 1, 77,000. 88,000 into 2 is 1,76,000. 1,15,000 into 3 is 3,45,000. 1,23,300 into 4, 4,93,200. Now make it total of this product. It is 10,91,200. And the total of this weights, 1 plus 2 plus 3 plus 4, total is 10. So weighted average profits is equal to, there is a formula. Weighted average profits is equal to total product divided by total weights. What is the total product? It is 10,91,200. This is the total product and total weight is 10. What is the answer? It is rupees 1,09,120. This is the adjusted profit. And the last step would be calculation of valuation of goodwill. I hope you have noted down. Please pause the video. You can note down. The third step would be valuation of goodwill. Third step, calculation of valuation of goodwill. There is a formula to calculate valuation of goodwill, that is weighted average profits into number of years purchased. Valuation of goodwill is equal to weighted average profits into number of years purchased. That is a formula. Goodwill or valuation of goodwill is equal to weighted average profits into number of years purchased. It is there in the problem, number of years purchased. What is the meaning of number of years purchased? And it is there in the problem. Number of years purchased, here it is 3 years. Number of years purchased means how long we can retain this profit, how long we can sustain this profit. Obviously we cannot earn the same profit for the next 50 years, next 20 years, next 30 years. Can we earn this weighted average profit 1,09,120 for the next 10 to 20 years? No. So number of years purchased means how long we can retain this profit, how long we will be able to earn the same profit. So they have given it as 3 years. It has to be multiplied by this weighted average. Weighted average profit already we have calculated. It is 1,09,120. Number of years purchased in 3 years. So the last answer would be rupees 3,27,360. Yes. This is the solution. Any doubts here? I hope you have enjoyed the video. Thank you so much for watching the video. I will come back with the next problem based on the valuation of goodwill. So please do like the video, please do subscribe the channel, please do share this video with your friends. Thank you so much.